Chapter 11, Adjustments to Income. The following forms and publications are used in the research and development of this lesson. Forms and publications are available at www.irs.gov. At the conclusion of this lesson, students will be able to understand adjustments to income and understand that they can decrease the taxpayer's AGI, or adjusted gross income. Students will recognize what adjustments can be reported on a 1040A and a 1040. They will understand when Form 3903 can be used. They will identify the difference between the tuition and fees deduction and the education credits, discussed in a later chapter. Students will learn the phase-outs and contribution limits of traditional IRAs and Roth IRAs. Alimony paid, penalty on early withdrawal of savings, student loan deductions, and that's actually interest deductions, teacher credit, and tuition and fees deductions. Adjustments to income are certain expenses which directly reduce the taxpayer's total income. Therefore, they are also known as above-the-line tax deductions, before you get to standard or itemized deductions such as Schedule A. You may be able to claim some of these deductions even without filing a Schedule A. They are called adjustments to income since they adjust or reduce the taxpayer's income to arrive at their adjusted gross income, or AGI. So the first section on income, each line adds for a total on line 22, and under adjustments to income, each line subtracts from line 22 to arrive at AGI on line 37 of the Form 1040. The first item is an educator expense. Now this is $250. It's not a huge amount of money, but it is the only educator, a business type work-related expense that is allowed on the front page or above the line and not having to be included under Schedule A itemized deductions. Only available for educators in kindergarten through 12th grades. Yes, you must have a work minimum of 900 hours per year, so many instances substitute teachers don't qualify. If the taxpayer and spouse are filing jointly and both qualify, they're both teachers, then each one can get the $250 apiece for a total of $500. If there are additional qualifying expenses above and beyond the $250 maximum allowed under adjustments to income, the balance can be included if you qualify under Schedule A deductions. It also may be taken on a 1040A or a 1040. Now, it was supposed to have ended quite a few years in the past and has been pretty much every year extended and extended, but it is believed that it will not continue to be extended past last year, so probably not available starting in 2013. A health savings account deduction can be a wonderful thing. As we will determine and learn in Schedule A itemized deductions, there is a minimum cap to medical expenses before any can be deducted on Schedule A. An option is if your employer, and that's where it falls under a qualified trustee or custodial to the account, usually an employer offers a health savings account deduction that allows taxpayers to put money from payroll into that account, and then the monies coming out can be paid for medical expenses and be an above-the-line tax adjustment. Taxpayers must be an eligible individual to qualify, and it can only be taken on the Form 1040. Further details must be used, including Form 8889 to claim the credit, and please review Publication 969 for more information. Now, to be an eligible individual and qualify for an HSA, you must meet the following requirements. You must be covered under a high deductible health plan on the first day of the month. You must not have any other health coverage except what is permitted under other health coverage, and you cannot be claimed as a dependent on someone else's tax return. A high deductible health plan meets the following requirements: a higher annual deductible than typical health plans, and a maximum limit on the sum for the annual deductible and out-of-pocket medical expenses. Chart down below shows for 2011 contribution limits, and they stayed the same for 2012. Distributions from HSA. Generally, medical expenses that have been paid during the year are not reimbursed by the plan until the taxpayer has met the deductible. Taxpayer may receive a tax-free distribution from the HSA to pay or reimburse for qualified medical expenses after they have established an HSA. Distributions received for any other reason is subject to an additional 20%. Your clients will receive forms that will show the amount of contribution. It could also be shown on the W-2 into an HSA, and there is an additional form. They usually come both. One top form shows the amount of contribution. The bottom form shows the distribution. The distribution is reported to the IRS, and if a client fails to give you that form and report that to the IRS, they will usually get a letter within 2 or 3 months of stating, oh, you forgot to include this additional income, and of course that will raise their tax. What is needed in the Form 8889, line 15 declares that all expenses from the distribution were used to cover reimbursed medical expenses. So that then it's declaring none of my distribution is actually taxable because I did use them for qualifying medical expenses. Now, an Archer MSA, I've not seen any of these, to be honest, in the years that I've been doing taxes. They certainly have them out there, a medical savings account, and it can be used when the taxpayer has low-cost health insurance with a high-deductible health plan. The taxpayer makes a tax-deductible contribution to the MSA, which is an IRA-type savings account for use when the taxpayer has medical expenses. That reduces his taxable income. Medicare counts as health insurance, which may disqualify an MSA unless a Medicare MSA is set up. If the taxpayer has no medical expenses in 1 year, the contributions remain in the account to be used in the future. So the idea of the Archer's MSA is that the amount of money you contribute into the MSA is what is adjustment and reducing your taxable income. The benefits of an Archer MSA are as follows. The interest or other earnings on the asset in the Archer MSA are tax-free. The taxpayer can claim a tax deduction for contributions they make even if they do not itemize deductions on Form 1040. The contributions remain in the Archer MSA from year to year until the taxpayer uses them. The Archer MSA is portable, so it stays with you if you change employers or leave the workforce. It can be set up by the taxpayer, the employer, or the self-employed taxpayer. There are complicated rules for the MSA contributions and distributions that are beyond the scope of this course, so review Publication 969 for more explanation. There are also flexible spending arrangements. Now, these are in lieu of health savings accounts that could be a wider array of expenses that will qualify. A health FSA is usually funded through voluntary salary reduction and allows employees to be reimbursed for medical expenses. An FSA is not reported on the tax return, and the salary reduction contribution limit is $2,500. Regardless of the amount contributed, the amount the taxpayer can receive tax-free is the contribution amount that was paid for qualified medical expenses. Another line of adjustments to income are moving expenses. Moving expenses are reported on line 26 of Form 1040. It requires Form 3903 to be claim to be filled out and submitted to claim this adjustment. The taxpayer does not need to itemize deductions to claim the adjustment. The qualifying deductible moving expenses are the cost of packing and moving household goods and personal effects includes 30 days of in-transit storage. Cost of connecting and disconnecting utilities. Travel, including lodging, but not meals. The IRS considers meals. You've got to eat whether you're moving or not. The key with the deductible moving expenses is that it must be job related. So there must be a reason of change of work, whether it's a transfer from one city to the other, whether it's change of jobs. You quit one job and you apply for and get another job in another city, and the distance must be greater than 50 miles. So if a person, and I have had clients that come in and basically they're just saying, I chose to move closer to my job. So there was no requirement to the job. They did not move because of a change of job. Simply, hey, I got tired of commuting so far, and then I found a new house closer, and so I bought it. In that situation, the moving expenses are not deductible. But when it is based on a job, I had been working in El Paso, Texas, and was transferred to the office in Monterey, California. That move was a qualifying move since it did change my job, and therefore these expenses were to be included. Tolls and parking fees also may be deducted. There's also a line for self-employment tax deduction. Self-employed taxpayers who have net earnings of $400 or more must pay both the employees and the employers half of Social Security taxes. Therefore, self-employed taxpayers pay both portions. They are allowed an adjustment to income, which is 1/2 of their total self-employment tax. Give them a little bit of a break because they have to pay both, unlike W-2 employees. Now, the tax is calculated on the Schedule SE, so you must submit Schedule SE. There it's calculated, and then you take that amount and put it on the appropriate line of the 1040. And you can only take it with the long form 1040. Now, there are several pension plans that a person is able to get involved in, and SEP is one of them, Simplified Employee Pension. A business of any size may establish an SEP, which allows employers to contribute to traditional IRAs, or in this case SEP IRAs, for their employees. There are 3 basic steps in starting an SEP. Must have a formal written agreement to provide benefits to all eligible employees. Must give each eligible employee certain information. And an SEP IRA must be set up for each employee. There is also the Simple Retirement Plan, savings incentive match plans for employees. A simple retirement plan is a retirement plan that uses separate IRAs for each eligible employee. Under a simple plan, a separate account must be established for each eligible employee. A simple plan is a tax-favored retirement plan that certain small employers, including self-employed individuals, and that's who usually does these, can set up for the benefit of their employees or of themselves. A simple plan is a written agreement, salary reduction agreement, between the taxpayer and the employer that allows the taxpayer to choose to reduce the taxpayer's compensation by a certain percentage each pay period and have the employer contribute the salary reductions to a simple IRA on their behalf. These contributions are called salary reduction contributions. There are also some other plans mostly set up for self-employed individuals. One is called COG or an HR 10 plan. Qualified plans may be set up by sole proprietors, partnerships, but not a partner, and corporations. They can cover self-employed persons such as sole proprietors and partners, as well as regular or called common law employees. Now, self-employed health insurance deduction, self-employed taxpayers can deduct as an adjustment to income on line 29, Form 1040. This expense is not included as a business expense under Schedule C to lower your taxable income. It is not designed to reduce net income, which impacts your Social Security and Medicare or self-employment tax. It is a deduction allowed, therefore it goes on line 29 of the front page under Adjustments to Income on the Form 1040. 100% of the amount paid in 2012 for medical insurance and qualified long-term care insurance for the taxpayer and their family if any of the following apply. 1, or A, the taxpayer is a self-employed individual, and the taxpayer is a general partner or limited partner receiving guaranteed payments in a partnership, or the shareholder owns more than 2% of the outstanding stock of an S corporation. The key is if they're self-employed and they're paying for health insurance, it is not a deduction under their business. It is a personal deduction that they can deduct off of their personal tax return. Another line item is penalties on early withdrawals from specific accounts. It is reported to the taxpayer on the Form 1099-INT. There is its own unique box for penalties on early withdrawal. It is reported on Form 1040 as an adjustment to income. Usually it's a nominal amount, $15, $20, but it is a qualifying adjustment to lower your taxable income. Alimony paid is also an adjustment and lowers your taxable income. Alimony is a payment or a series of payments required under a divorce or separation instrument and meets certain requirements. The recipient reports the payments as income. Now, if you by chance know that the recipient did not report the payments as income, that does not obligate you to report it as, I apologize. Pause. Change that a little bit. You're reporting alimony paid as an adjustment, reducing your taxable income. If for some reason you choose not to do that, then the one you are paying alimony to does not have to report it as income. But I've not run into that situation, but there is that possibility. If, however you are feeling, you are choosing as the taxpayer not to report that as an adjustment to income, let the person you're paying it to know so they don't have to report it as income. Otherwise, yes, the payer still must report the payments as adjustment to income, and the one receiving it must include it as income. You must have the recipient's Social Security number to claim the adjustment, and in some states, also the name is required. Remember, child support is not alimony and is not deductible. What I have seen lately is a form called family support, that it's all lumped together. So it's very crucial that you determine the amount that is called and considered child support versus that which is spouse support. Spouse support is another name for alimony and is a deduction. Child support never is. And I've had discussions with men who are paying heavy child support, and they get rather upset that they cannot deduct it as a deduction and reduce their taxable income. And there was one particular gentleman who was just fussing on and on about how he can deduct, and it's not fair and it's not right, and he has to pay all that money. And I finally had to explain to him, well, everybody pays child support, and anybody who has kids pays child support. And he looked at me, really? I said, certainly. The only difference between myself and you is my children still live with me. But anytime they want food, anytime they need clothing, anytime they want another Xbox or a game, that is child support. And nobody can deduct child support. That seemed to help him understand the difference, and he was better with it going forward. Another deduction is IRA, traditional IRAs, contributed with pre-tax money. One of the advantages of IRA, putting money into an IRA, first of all, they cannot have also employer-sponsored plans. So if they already are under a employer-sponsored retirement plan, they may not also be able to, or it could limit the amount that they can include into a traditional IRA. Additional research would be needed. The other advantage is, as an example, a few years back, did not correctly calculate how much I needed to withhold throughout the year, leaving me at the end of the tax season, or at the end of the year, with a balance due to the IRS. I owed them $1,000. Well, I looked at the traditional IRA contribution, which I am qualified for, and I calculated that if I put $4,000 into my IRA, it would lower my taxable income enough to where I would get a small refund and would not pay the IRS that $1,000 balance due. The beauty of IRA deductions, for instance, this is 2013, I could include under my 2012 tax year, monies entered into IRA all the way up through April 15th of 2013. And it's allowed. Now, it's very important, as I made that decision, to let your brokers know, or who handles your IRAs, that your contribution is going toward the previous year's tax year. So I noted and put in there that it was for the previous year, and I could pay that up until April 15th of the next year. So very helpful tool in case you find yourself having a balance due. I'd rather take the $4,000 out of savings and put it toward my IRA than pay the IRS an additional $1,000, and it's perfectly fine to do so. The maximum contribution for an IRA under age 50 is $5,000, and over 50, called catch-up years, is $6,000. There are phase-out amounts, meaning if your income is over the thresholds, you do not qualify and cannot put monies into a traditional IRA. And adjustments may be taken on Forms 1040A or 1040. Here is the maximum IRA contribution limits. If you go over these limits, then you will pay a penalty up to 6% of the overage until you remove it, and that's annual. So very important to maintain to the limits of IRA contributions. Roth IRA qualifications: taxpayer must have taxable compensation, you must have earned money, and the taxpayer's modified AGI must be less than $179,000 if married filing jointly, $122,000 for single or head of household, and $10,000 for married filing separately if the taxpayer lived with their spouse at any time during the year. Obviously, this does not reduce your tax, so it doesn't affect your refund or balance due. The contribution phase-out range for 2012, there it shows you based on filing status and modified AGI. There is also student loan interest deduction. So very nicely, clients who have education can deduct the expense of education. Now, there are limitations to what expense you can deduct, but also if you have to take out a student loan to complete school, once you start paying it back, the interest you pay can be a deduction as well. So taxpayers who have education loans can deduct up to $2,500 of education loan interest paid in 2012. Now, it's not a guesstimate on the part of your client. They will receive a Form 1098-E that will declare the amount of interest, not the full loan, not the principal, just the interest paid on payback of student loans. That is a form that goes to the IRS, and you can include that on line 3 of the adjustment to incomes. The deduction is allowed on qualifying loans for the benefit of the taxpayer or the taxpayer's spouse or dependent at the time the debt was incurred. The deduction begins to phase out at incomes of $75,000 or $150,000 for married filing joint. And married filing separate individuals are unable to deduct. There are many credits and different deductions that don't qualify for married filing separate status. Tuition and fees are another deduction. Tuition and fees deduction adjustment to income could be up to $4,000, and this deduction may be beneficial to taxpayers who cannot take education credits because their income is too high. and they may take it on forms 1040A or 1040. Generally speaking, the education credits will give you a greater deduction and reduction in the amount of tax to pay or increased refund. But here is a viable option just in case. The expenses is based on qualified education expenses the taxpayer pays for themselves or their spouse or a dependent, for which the taxpayer claimed an exemption on their tax return. Generally, the deduction is allowed for qualified education expenses paid in 2012 in connection with enrollment at an institution of higher education that during 2012, or it could be for an academic period beginning in 2012 or in the first 3 months of 2013. That would have been paid in 2012. Even though the course wouldn't be taken until 2013, you can still claim it because you paid for it in 2012. Now, this also would give you, your clients would receive a Form 1098-T to show qualifying education expense. And there are other items that will show you in the education credits chapter that will indicate what is a qualifying expense. That essentially covers in general adjustments to income. There can be other options. Please look at and review in the book everything about adjustments to income. And in the meantime, do the Chapter 11 review questions and TPAs online. Be sure to read Chapter 12. And of course, any questions or TPAs you need to pass with a 70% or better. Thank you.